Welcome to the daily update, where I'll go over the action in the market for Monday, April 7th, and then we'll see how things look for Tuesday, April 8th. Okay, we're seeing some slight improvements. It was a crazy day, very choppy. We saw a big swing going down right at the open, and we shot up on some false news, and then it came back down, chopped around, and ended up closing slightly lower. So it was a down day, and we are still quite negative. But it does appear that there could be some stabilizing going on. We're seeing little improvements with some of our charts. When you get to the point where this is all that people are talking about, it's tariffs, 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 and then of course you have to look under the surface and go, there's more to the story than just this. It's not quite as black and white as it's being made out to be by some folks, but it's really had the markets rattled. And it's not like this was a surprise. We knew these tariffs were going to be enacted, and at least we were told that. We thought, well, maybe not really. Maybe it's just talk and no action. Well, now they're kicking in, and this really caught a lot of folks off guard. And it's taking a lot of the strength that we've seen out of the market over the last couple of years. Now, is that froth that's being removed, or is this just an adjustment over to things going in a new direction? That's what we're trying to figure out now. But as I said, we are still negative, quite negative. If we do get some kind of a bounce and see a few more improvements, we're going to be watching the quality of that bounce because we went down hard and fast on Thursday and Friday last week. It looked like we were going to go down again. Everybody was predicting a crash. And of course, when everybody predicts that, that's when it doesn't happen. And so we'll just kind of keep an eye on this and see. It's just kind of a settling down point before we do get set to go lower because we are seeing bigger picture technical damage done right now, but possibly just a little bit of a respite as the markets try to soak things in. And the idea behind the stock market, it's become pop news. It's what people are talking about. It's headlines. That's about the time when the craziness is about ready to end, at least for the short term. And then the craziness will continue. It just won't be front page news. They'll move on to something else. It becomes more of a pop news type of a thing. We saw this last summer with the end of the world day that happened, and that lasted a few days. But then we bounced up out of that. This is different in that, okay, there's the initial shock that yes, the market's overreacting to this. Maybe it'll stabilize a little bit, and then we'll have to see what do we settle into? Are we going to see some improvements or are we going to start to go back down? So I have a number of additional charts for things that we're keeping an eye on because we can get some insight by looking at these charts of the shift going back and forth. For example, last week, folks were getting out of the stock market into the bond market as a flight to safety. Well, now we saw that shifting back in Monday's session. Is that going to continue? Interest rates are going back up, which were actually seen as a good thing in Monday's session because that meant money was coming out of the bond market and possibly going back in to the stock market. Okay, so it's really complicated right now. And just to use two or three little indicators or just, try to get to a black and white consensus is pretty much impossible. And that happens every day, but it's even more difficult when we go through more complicated times like we've been dealing with lately. Okay, so we had a gap lower open. The futures were down. It looked like, okay, we're just going to see another continuation of what we saw on Thursday and Friday. We gapped lower on Thursday below S2. We gapped below S2 on Friday. We gapped below on Monday, and only this time S2 was at 49.23. And then prices set the intraday low right after the open. We actually dropped down below 4,900. Lot of points are coming off in the S&P 500. And then this is when that fake news story came out that, oh, maybe Trump's going to delay the tariffs for 90 days. And the market shot higher and went all the way up almost to 5,000 at S1. And we got above S1, we got above the unchanged level, the daily pivot at 51.45, and we almost got up above R2 at 52.21. that that's how quickly things were really shooting up. They were just dying for some kind of positive news, and that shook the markets. Well, then that became known that no, this, at least according to the White House, this is not what is going to happen here. So then prices then declined and chopped between the unchanged level, went a little bit above the unchanged level, and then down to S1, a little bit below S1, and then we closed slightly negative. So after all that was done, this huge intraday move that we saw, we were down 0.23%. Volume is still quite heavy. You've got a lot of folks that are having to readjust their thinking and readjust their portfolios and what they think is actually going to happen here. Now, we are still negative in the short, intermediate, and hanging on to being positive on a trending basis in the long term. But the longer we stay below the 200-day simple moving average, the more that 50-period moving average is going to come down and possibly cross over negative. And we will get some inflation reports later this week. We'll have to see if there's so much noise going on right now. Is CPI and PPI, are they even going to matter? Well, interest rates did go back up, but that was more of a reverse of the flight to safety in Monday's session. And some of this that's coming in are these earnings. And over the weekend, I went through this in the weekly videos where the earnings are still looking positive, but they're coming down from the forecast that had been anticipated, and the market is taking that as negative. And then there's this back and forth. Are we going to go into a recession? Are we not? We're watching things. There's a lot of charts that I look at. There are additional videos that I post on the website, which there's a link right below this video if you want to go check out the program that I have. I haven't posted any recession type videos lately, but I'm keeping an eye on those charts. And there are some that are causing some concerns. There's others that are going to take longer to actually update here. And all of it's about what's going on with all the changes with the Trump administration that they're trying to enact here. So it was a very choppy session, swinging. We were down as much as 4.7%. That was right after the open. And we were up as much as 3.4%. My goodness. What is that? An 8.8% swing in one day? My gosh. Now, what helped things is that the mega caps and the semiconductors, they have been so beaten down lately. They saw a bit of a bounce, and that helped things stabilize just a little bit. This is the erroneous report that NEC Director Kevin Hassett and President Trump is considering a 90-day pause on the tariffs, except for China, of course. The White House called the report fake news, and later, President Trump indicated that the U.S. will impose additional 50% tariffs on imports from China starting Wednesday if China does not withdraw its 34% tariff on U.S. imports. So there's some hardball action going on here between China and the U.S., and that's going to add some instability to things. Now, right as I started recording, which is about 7, 8 hours before the market even opens, the futures are up over 1%. So there's some positive news coming out of Europe that, hey, we'll take away your tariffs if you take away our tariffs. And that might be adding to some positive things going on. And then bonds did decline after the flights to safety subsided. Now, this could come back at any time. People getting out of the stock market, going into the bond market, that's seen more as a safe haven because of all the volatility that's happening in the stock market. We're still getting just a really high reading with the VIX at 46.98. So we get concerned when it's above 20, and we get more concerned when it's above 30. It's still above 40, and this is when we see quite negative annualized returns. We still have a pretty long list here with our short-term indicators, including the short-term trend, and I'll show you charts of all these things. We're still extreme with the 20-period exponential moving average. The VIX is still moving quickly here. The rate of change in the short term, 5 periods, 10 periods, 20 periods, we're still extreme negative there. The Stochk RSI, the Williams percent actually fell off the list. There was enough of a bounce that it saw something positive. But the CCI 14 and 20, the stochastics, the force index, and we're still far away from the 20-period moving average as measured by the boom indicator. And then the short-term RSI. We have an addition here, the CMB composite. That wasn't on the list after Friday, but it was on the list after Monday. And then the intermediate term ADX, that's the trend condition indicator and kind of the foundational indicator that I use. And that's still extreme. It's getting above 40. We're also going down still with the 50 period exponential moving average on the S&P. We're still in the -3 channel with our standard deviations chart. The rate of change going back 50 periods, that's intermediate term. The Arun indicators, extreme negative. The PMO and the studies that go along with that are still negative. So not a lot of improvement, just little ticks up in some of these indicators. The Sean trend meter and then the bullish percent index for the S&P and NYSE, where the NASDAQ 100 bullish percent index is quite extreme. And I have an extra chart to show you of that. The percent B, there wasn't enough of a work off there to change that. And we're also seeing that on the weekly chart, which is a pretty strange thing. Doesn't happen very often. And we're also far away from the 50 period moving average and then the RSI intermediate term based on 14 periods. That is still extreme. And we're still looking extreme with our long-term moving averages, the 150 and the 200 period moving averages there. No changes to the Fed. They're kind of in the background right now. And so they're just kind of, all right, we'll just see how this plays out. Now, Jerome Powell did speak on Friday, but then he said, "Oh, yeah, these tariffs, they could cause some problems, you know, but the Fed's not going to do anything about that." So, not really playing a big role at this time, but that could always change. The dollar was up and interest rates were back up. We had closed below 4% after Friday at 3.99%, which sounds great, but why are the rates going down? It was because of this flight to safety. Well, we saw a bit of a shift back that saw bonds going down. So we closed at 4.16% with the 10-year yield. Sentiment, man, just, I don't even know if this thing can go negative or not. We're still seeing a very pessimistic market right now where we're not only below 25, we're down to 4 here. And we're still inverted with the 10 to the 3-month yield curve, and it's a little hard to see here, but we're negative as far as our trend, but it's getting rather extreme. And I'll show you that chart. And we had a slight down day, but overall the bias has undoubtedly been negative, as has been the momentum. Okay, so we just had consumer credit, which it's kind of like, it was a lot less than people expected. They expected it to be at 15.1 billion. It came in at minus zero point 0.8. It actually declined there. Last time it was at 8.9 billion. So people are, maybe they've maxed out their credit cards as of this point. And here's a chart just to show that how we're actually seeing it negative after a really, of course, Christmas here, December, a lot of charging on the credit cards there, and then it dropped off in January and it continues to drop off here. Okay, so then the earnings per share, they've dropped by a median of 13%. This is what the market's kind of having some problems with right now is that, okay, the earnings might be positive, but they're actually getting revised down. And this is the average since World War II. It's 13%. We're right now looking here that it's even been a little bit more than that. Then this, we're also talking about valuation, where we're actually dropping under 20. If you go through the intermarket analysis video that I do over the weekend with the forward-looking PE ratio, this is NTM, the next 12 months. That's also another name for the forward PE. We actually are down into the 18s right now. But anytime we get above 20, that's considered to be expensive. It's still over 20, both with the NASDAQ and then the Russell 2000. Even though the small caps have just been getting hammered, they're, according to this, their PE ratio is still quite high. And then the equal weight is more fairly priced, as are the mid caps. 15, that's considered to be fairly priced. All right, then we're seeing money coming out of the market. This is the equity positioning as the market's been going down. And then we've lowered our 2025 fourth quarter GDP forecast by zero point 0.5 percentage points or to 0.5%. This is a lot of stuff here on this chart, but just know that there are folks coming out that are predicting that they're either lowering GDP. There's even a couple of forecasts out there from the Atlanta Now. I always say that wrong. The GDP Now from the Atlanta Fed. They have negative GDP, but the New York Fed has positive GDP. So go figure on that one. But the markets are trying to figure out what's this going to do to growth? What's this going to do to earnings? And at the beginning in 2025, of course, we had these massive projections because we just had two 20 plus years of growth back to back, 2023 and 2024. Well, now that things are under pressure, all those numbers are getting revised down. It's basically a reaction to what's happening. All right, then huge 2-day drops have been quite bullish. Now, according to what Carson came up with, is when we have going back to 1950, big drops like we saw on Thursday and Friday, that usually is good going forward. Okay, we'll have to see. Are the fundamentals a little bit different? This may produce some kind of a bounce. And as I said before, if we do start bouncing up out of this, then we'll reevaluate that. Is growth starting to outperform value? Are we seeing some improvements with our other charts? Is there some real strength coming back into the market? Or is this just a bit of a bounce before we're getting set to go lower? All right, so here, the very choppy day here, and we gapped down below S2 and actually broke set the low right after the open. Then this is when that fake news came out, and then we immediately shot up, actually got above R1 and just about hit, well, we did hit the 5250 level. So I mean, this is a massive swing here. It doesn't look like all that much, but see how much we've been moving lately. It makes the current moves look a little bit more muted here. And then after that was settled as far as, no, that's not really happening, then we just kind of chopped above and below the unchanged level, above and below S1, tried to go up and go positive here, but that really didn't last, trailed off, and then ended up closing a little bit negative on the day. And we are seeing some improvement here. The pink area, these are the initial overnight session, and we're up over 1%. But this just shows all the choppiness and all the craziness. We gapped lower on Sunday, and then we tried to bounce up a little bit, came right back down. And then this is just a market that's freaking out right now. We'll see if things can stabilize. We're seeing possibly some improvements here where the red line and the blue line, they're pretty much in line with each other now. And they're both been under a lot of pressure as everything was getting sold last week. We'll see if what tends to emerge if we see more bounce from here. Is the red line going to go above the blue line, or is the blue line going to outperform? We want the blue line to do better to turn more positive. But they both have been going down ferociously the last few sessions. Seeing a excuse me, seeing a little bit of an improvement here with the growth to value ratio intraday for the S&P. So, but again, we've seen this before and then it's just fallen apart. So we need to see a longer term trend for things to turn more positive. End of day, growth was up where value was down. And then value was down less for growth was down less for the mid caps and a little bit less, but still pretty strongly down with the small caps. So a little bit of an improvement with our small cap growth to value ratio, but we're still hanging out down around the 200-day moving average. We're under the 200-day moving average with the mid cap growth to value ratio and way below. And we're getting ready to see a death cross here with the S&P growth to value ratio. This is going to turn things more negative because we've been in an uptrend, and this is what helps the market go up when growth is outperforming value. If this continues to decline, that's meaning the market's getting more defensive still, and that is more negative. And saw a little bit of a tick up here with the growth to value ratio here, but it's still quite negative. Little bit of a downward move here with discretionary to tech. This is another kind of growth versus value area. We want this to be going up when we're more positive. This going down is negative. And here's the intermediate term ADX. This is what I base things around myself, where the ADX is not above 40, but the red line's just shooting up. It's getting almost to 50. And this could suggest that, okay, maybe we overdid it on the selling side here, and this could help stabilize things a little bit. But we are in a strengthening negative trend for right now because we're above the moving average, and the red line is clearly way above the green line. Short term, we're actually moving above 40. And not only do we have the red line above 40, it's actually above 50. We have the ADX, the dark line itself, that is above 40, suggesting that, okay, maybe this is getting a little toppy because we don't see these readings very much. And volume is really spiking up. It's also more apparent here on this newer chart that I've been showing, where we're seeing a massive amount of volume right now. And sentiment, this is ticking down into the more negative area. This is a weekly chart, which is a composite of a bunch of different sentiment gauges together. Where our reading, we're down at 4. Okay, this is coming in at 30.96. And we're getting a little bit more bullish here with the legal insider transaction ratios. It's actually coming down just a little bit. We're still getting a very high reading with this other sentiment gauge, the Ulster Index. The VIX is still just sky high here. But notice how we closed way off of the high. It really spiked up. It got up to 60 here, but we closed down at 46. I mean, 46 is still really high, but not as high as 60. And so we're coming down just a little bit here with the line chart, and we're actually surpassing what was set back last summer when the VIX really spiked above 65. Intraday, we got close to that on an intraday basis, but we're actually higher than that on a closing basis right now. And as the VIX continues to go up, the VIX of the VIX, the volatility of the VIX continues to go up. This is Tom Balley's research. He's connected with stockcharts.com and earningsbeats.com. He did the research behind this chart. And it just shows that when we're above 20 with the VIX, we have negative annualized returns. When we're under 20, the further we go under 20, the higher those annualized returns are. And since we're up in this area, that's more negative on an annualized basis for the markets. Still getting a very high reading with the VIX. It's moving up really quickly here with the RSI based on 9 periods. The momentum of the VIX is clearly up as measured by the MACD. This is comparing the spread between risky and not as risky bonds. That's the black line that we see here. And it is going up, but it's not where we saw it back in the COVID plunge. It's not where we saw it back in 2022, but it is going up, and that's causing some concerns. And then the red line, this is the VIX here as well. And these two tend to move more hand in hand with each other. I have another chart of this that I'll show in a moment. This one fear gauge really going up here still, and we're also really increasing with this fear gauge, but we actually ticked down just a little bit from Friday's reading. This is the other chart of the spread between risky and not as risky bonds. This is going up, but we're not getting back to previous levels. But the fact that it is going up means there's an increase in fear, and that is a concern. And this is an inverted version of that same chart where we're really continuing to drop here. And we declined a little bit with the equity put call ratio, but we're still going up with the 5-day chart and we're going up with the 10-day chart. That just shows the fear as there's been an increase in hedging in the markets over the last 5 to 10 days. We ticked up a little bit with our risk on to risk off ratio after it had really been falling. It really just tanked in Thursday and Friday session. So a little bit of a bounce here and a little bit of a bounce when we look at the high beta stocks. Those are the high flyers like Apple, Amazon, Netflix, Google. They bounce back up a little bit here compared to the more conservative stocks that tend to hold up better when the market's going down. Coming up a little bit here, but still in this band when we look at the volatility risk premium. So that's picking up after it had been quite low, even despite the declines that we saw last week. And we're showing some weakness here with the advanced decline line based on price, but we're still above the moving average. We're dropping further below the moving average here based on volume. And a little bit of weakness here. We were just a little bit below zero after Friday with the 10-day advancers minus decliners. This is going down. This is showing more money actually coming out of the market. And seeing internally just a continuation of a deteriorating market structure right now. Really, when we had that lower open, set a whole bunch of new lows. So our 5-day chart's going down and our 10-day chart's going down. We're below zero and declining both in the short and intermediate term with the advanced decline ratio. This breaks out the advanced decline ratio based on 19 periods, and we're below zero. That's already negative, and I showed that on the previous chart. That was the blue line. Well, this also gives us volume, and that's showing that there's money coming out of the market instead of more rotation that we had been seeing leading up to Thursday and Friday last week. And we're below the moving average now with accumulation distribution. So this smart money indicator is negative, even though it ticked up just a little bit. And we actually saw a bit of an improvement here with the chicken money flow, but the red line's still going down. So smart money indicator number 2 is still negative. and we're still declining with the Chaikin oscillator. So our three smart money indicators continue to be negative. The vortex is negative with the red line above the green line. And I haven't been showing a lot of the advanced decline line studies lately because you can see we've just been chopping sideways here. Even the cumulative, which tends to be a little more active, it's falling here, and that's what happened on Monday, but we haven't really been breaking down here. We're seeing a little bit more of movement here when we look at this based on volume. And we're dropping below the midpoint now with the 10-day average of the highs and lows for the S&P. After Friday, we were still positive. This is now picking up Thursday and Friday's declines in its calculation because it goes over 10 days. And this is looking more negative. This is a little bit longer term negative. And we're dropping below zero with the 50 period moving average of the new highs, new lows. That's turning things even longer term more negative. And here's the NYSE cumulative advanced decline line. We really fell here. We're falling with the regular NYSE advanced decline line, and we're falling below the 200-day moving average with this other NYSE advanced decline line. So where this had been holding up better as we saw more rotation going on, we are still seeing internal weakness coming into the market. And here's the common stock where we're seeing a decline based on price as well as volume on the NYSE. And we're below the moving averages and declining here with all of our advanced decline lines. The NYC common stock, the S&P, the mid caps, and the small caps. And this is negative here. And we're really dropping off with the new highs, new lows. Now, the black line, that's the daily reading, which was really low. The red line that's harder to see, that's a 50 period moving average, and that's crossing down below zero and it continues to decline. That's also another negative internal measure there. And then we look at another broad market measure and look at a 5 period moving average, really dropping down. In fact, we're getting below this red line, which sometimes that suggests that we might be at or near a bottom. And folks may want to start to come in and buy. And we're still getting a really extreme negative reading with those stocks in the S&P above their 20 period moving average. It's 2.6. 2.6% of stocks in the S&P are above their 20-day moving average. Okay? 2% to between 2 and 3%. That's like almost nothing. But this is an extreme negative reading. We're also getting extreme negative with the 50 period moving average study, still seeing more deterioration with the 100 period moving average study, and 20 stocks are above their 200-day moving average in the S&P, just 20%. So this is quite extreme. And when we get these extreme readings, at some point, price is going to be attractive to some folks, and they may come in and start actually doing some buying. Short term, just really seeing a lot of decimation lately. But we closed well up off of the low, excuse me, and we even closed up off of the open. So this bar is just all over the place here. And we're still extreme negative with the 2050 and getting close with the 200 period moving average study on the S&P. The Stochk RSI is still extreme negative, but we ticked up just a little bit. We're no longer extreme with the Williams percent R. The CCI 14 bounced up, but is still extreme, as is the CCI 20. And we're no longer extreme with the short-term stochastic, but now we're extreme with the intermediate short-term stochastic and the long-term stochastic. And force index way down. It has to rise up quite a bit just to get up to the Keltner band here, but it bounced up a little bit. And we're still not on a closing basis, not in bear market territory. We started the day there, and that's when we saw some things show a little bit of improvement. So are they going to try to keep the S&P out of a 20% decline from the all-time high? We'll see. Well, they kept it out on Monday. We're still down 17.61% from the February high. Now that's on a closing basis. I measure this a little bit different in a chart that I have coming up where we're actually more than that. The short-term moving average still looking quite negative here and really picking up with the Landry volatility. For some reason, I want to call this laundry, and I've been saying that word wrong, but it's still getting a very high reading. That's just showing volatility with the S&P. This is the other chart here. Where if on an intraday basis, if we go to the all-time high set on February 19th and then to the low set on Monday, we're down 21.4%. But the market uses a closing basis. And so we're still under that 20% range as of Monday's close. We're still extreme negative with the rate of change going back 5 periods. That's short term. Also, short term is the 10-day rate of change, which is extreme negative. Bounced up a little bit here with the 20-period rate of change. That's also short term. And we're way down here. We're in even going outside of the -3 standard deviations channel. Just as the market has just been tanking lately. Now, this is a newer chart that I ran across over the weekend. There's what CPI is going to come out with inflation, and there's the GDP version, and there's core PCE. According to this site called Trueflation, they have inflation at 1.4% underneath that 2% level. And here's a chart just to show this. I don't know. This is kind of a new source that I've run across. We'll have to see how legitimate it is. So I'll start including this from time to time just to see what kind of readings we're getting. All right, intermediate term actually ticking back above the midpoint with a balance of power. And we're extreme negative though with the CMB composite. We're below that black line. We're bouncing up and no longer extreme with the Connors RSI. We had been extreme negative after Friday. We saw a little bit of an improvement there. Still quite negative with the go, no go with the dark purple lines, and still just falling off here with the lowest low value part of the chart. Still looking negative and getting back down to this black line with the TTM squeeze. And the condition of the intermediate term trend still very weak. The blue line and the red line continue to decline. Still breaking through a lot of these anchored moving averages here, but we're trying to get back to some of them. We're not quite back up to this previous purple anchored moving average yet. A lot of damage was done, and we're going to see if the market's going to try to get some of that back. And we're still far away from the 20-period moving average, and the 50-period moving average is measured by the boom indicator. This could also still suggest a bounce as the price tries to move back to the moving averages. And extreme with the intermediate term rate of change going back 50 periods. So we're seeing lots of this happening in the short and intermediate term. Standard deviation, because we've been going so fast, it's really picking up the speed of the movement recently. Still going down here with the ease of movement. That's negative, and still extreme negative with the Arun indicator as sellers far outnumber the buyers. And not quite extreme, but we're negative with the McClellan oscillator for the S&P. If we drop down below this line, a lot of times this signals that we're getting extreme negative. Now you notice throughout February and even into March, we've been kind of around this area. This is the rotation that we've been seeing, keeping the internal side of the S&P holding up a little bit better. Now we're starting to see more panic selling as things have been coming down. And so we're going down with the summation index based on price and even more so based on volume. And we're not quite extreme here with the NYSE McClellan oscillator. That's showing more weakness. So we're going down with the NYSE summation index based on price and volume. The Swollen Trading Oscillator declining based on price and volume. And extreme negative here with the PMO. This is a momentum oscillator going down based on price, going down a little bit more based on volume. And the PMOs that are above, that are rising here is actually extreme negative. The buy signals are extreme negative, but we're still declining with the PMOs that are above zero. Negative here with the Elder's Impulse system with the red bars for the S&P, and negative with the parabolic SAR. The weekly chart continues to be negative as well. The slope oscillator, now we're dropping back down below this red line. It doesn't really look like it because we went real extreme negative going into March. We came all the way back up to the midpoint. Now we're dropping below this red line again. So this is getting extreme negative. And the MACD is falling further below the midpoint here. That's more short to intermediate term negative. So all of our momentum oscillators, short, intermediate, and now even the long-term ones have all rolled over. Choppy curve is negative. That's a momentum oscillator. We're below all the plotted moving averages here, and we're down messing with the volume bars. They're getting mixed up with each other right now. We're still extreme negative with the Sean trend meter. We're declining, but not extreme with the money flow. We actually ticked up a little bit with the ultimate oscillator, but it's still negative since it's below 50, dropping further below the moving average with unbalanced volume. That's negative. Getting even more extreme negative. With that gap lower, it produced a whole lot of point and figure sell signals right at the open. This is a very low reading. This also might suggest we could see some kind of an attempt at a bounce at some point. We're getting a really extreme negative reading with the NYSE bullish percent index as well, and very negative with the NASDAQ 100 bullish percent index. Just to give it a little perspective, this is the extreme negative readings over the last 20 years for the NASDAQ 100. And we're coming down to a very low reading. This is the COVID crash here. And so this also could suggest that maybe things have been overdone. And at some point, this buy the dip, ooh, I can get in at a good price. It's a professional's market right now. I heard somebody say that over the weekend. It's like if you want to just do this on a short-term basis and you're trying to buy a dip, you're going to get decimated until things get a little bit more clear. But we're getting an extreme reading here with the bullish percent index for the NASDAQ 100. And we're still working off of a buy signal with the mass index. It's trying to pick up some kind of a reversal that just hasn't happened yet. Still working off of a buy signal, but this is starting to go into the background more. This was actually triggered back in March. The further we get into April, the more irrelevant this will become. And let's see, this is also showing that we're far away from the 20, 50, and not extremely far away from the 200, but these are extreme negative readings with the boom indicator. And the percent B did tick up, but it's still extreme negative below this red line here. And we're still extreme negative with the RSI 14 and the RSI 9. And this is a shorter term fib retracement chart going from the low set a year ago, April, to the all-time high. We've done a whole 100% retrace of that. So all those gains from a year ago have now been given back, although we are bouncing back up from that a little bit. This is a longer term fib chart going back to the October 2022 low to the all-time high. Notice how we came right down to 50%. And so far we've been holding above that level. The market sees these things, and this is when we saw things start to improve. Now we closed up well off of the low. Can we try to get back this 38.2% retracement level? This is some of the slight improvements that I've been talking about here. And this is also interesting. Now, it's negative that we closed below this pivot point here. That turned things quite a bit negative. After Friday, we closed right at S1. We opened down below it, and we came right back up to it. These are other levels that the market sees, and so far this S1 support level is holding. And we're coming right back up to the midpoint. We fell down below it at the open on Monday, and now we're just a little tick above it now. This is longer term with this trend channel. So these support levels are holding for the time being, but we're still negative on a trending basis here with the Heiken Ashi. We're still going down with the Kegi chart, the Reiko chart, and the three-line break chart. The trend is clearly negative, and we had enough of a lower open to draw in some more O's here. And we're looking at a descending triple bottom breakdown, which was generated on April 3rd. Okay, and we're getting pretty extreme here with the 150 and the 200 period moving average study. And we're still negative in the short and intermediate term, negative with the mid caps and the small caps in the long term. And then we're we had such a down day with bonds based on price, it actually switched to a downtrend where we're in a downtrend in the short and intermediate term with commodities, and the dollar, even with its bounce, is still in a short and intermediate term downtrend. And this was more encouraging. Tech and communication. These are true growth areas. Now, they weren't up anything all that drastic, but they were positive, where all of the other sectors ended up being negative, with staples being down. Discretionary was still down. That didn't help things, but real estate, another area that's considered defensive, that ended up being down the most as interest rates were going back up. Okay, and then this is all the alerts. And a lot of these were triggered right at the open. It started here 15 minutes after the open, and then pretty much all of these were generated right at the open as well. And then things started to look a little bit more positive as we were bouncing around here. But there's still a lot of damage that needs to be repaired. Still going down both with the S&P and the equal weight version of the S&P. They're more or less in tandem with each other here. Little tiny bit of an improvement with the weighted versus the equal weighted version of the S&P, but it has been going down for the most part. And saw still more of a decline here below this S2 level with the Dow. We're negative with the Dow when we look at the Elder's Impulse system for the diamonds. And the NASDAQ came right up to this S2 level. Isn't that interesting? We were able to hold to that support level. But notice we're getting really near a death cross here with the trend. And then we're still negative with the Elder's Impulse system for the NASDAQ. And we came right up to this S2 level again here with the NASDAQ 100. Okay, so that's still holding for right now, but we're also getting near a death cross with the NASDAQ 100 trend. We're still negative though with the Elder's Impulse system with the Qs. The momentum for the NASDAQ 100 is negative. Small caps, they already are in a downtrend here, and they ended up closing below this S2 level. So not any improvement there. They declined another 1.33%. And still looking at the other small cap index, extreme negative with the RSI, but really very little bounce. We did close up. No, this actually, it's getting mixed up in the volume bars here. It's a little harder to read. And the momentum for the small caps are pretty negative right now, too. We're negative with the small caps with the Elder's Impulse system. Mid caps also a recent death cross coming down over 1%. Negative with the Elder's Impulse system for the mid caps. The Wilshire did bounce up, closed well off of its low, but it has quite a ways to go just to get back to the 200-day moving average, as does the total U.S. stock ETF. But this is kind of encouraging to open lower. We did go higher, so we closed off the high, but we also closed well off the low. In the financial sector, underneath its 200-day moving average, I picked this up over the weekend where it was one of the fewer areas that closed off of its lows on Friday. Both that and the chart I'll show right after this. Now, there's still a lot of damage here, and we really need to get back above the 200-day moving average, but this could be a little encouraging. And we actually saw this ratio going up a little bit. When we look at the smaller banks to the financial sector, we did close up off of the low on Friday, and this was actually up 0.25% in Monday's session with this ratio. Little glimmer of hope there. The FANG index well below its 200-day moving average, but also closed off of the low. And semiconductors, they were up 3.5%, but still we're in a downtrend here. And robotics and AI, it was still down 2.29%. This is not a really good looking area right now. And then Apple was down 3.67%, and we're just starting to form a death cross here with the trend for Apple. Amazon was up 2.5%, but has yet to get back to its 200-day moving average. Microsoft in a downtrend, down 0.5%. Google starting to see a death cross here, but it was up 0.79%. Nvidia in a downtrend, up 3.5%, but it's like it's got a long ways to go to start looking better. Meta up 2.28%, but still not back to its 200-day moving average. Tesla, it was down 2.5%, and we're getting close to seeing a death cross here. Netflix still above its 200-day moving average. Out of all the magnificent 7 or 8 or however many stocks you put in there, this still is looking about the best, and even this is looking pretty ugly right now. And then the staples to tech ratio, which has really been spiking up, did come down a little bit. Little slight improvement there. And the semi to tech ratio bounced up a little bit. Slight improvement there. And then we're looking at the SPY to staples ratio, kind of longer term, because this is how things started to look as we were ending 2021. Remembering that we set the high for the S&P into 2022. This started to really disintegrate before the market started to turn down. We're watching something similar to that happening right now, and we're still getting a very low reading here. But this is what we've been watching. This is when I talk about the market getting more defensive. When this is going down, that means the S&P is underperforming staples, which is a defensive area of the market. And so this coming down, yeah, it's very negative. Are we going to at least pause for a little bit here, or are we going to see a real bounce going back up? And then international versus US stocks, we're seeing a pretty strong correlation as everything's tanking right now. Also seeing more of an improvement with the longer term correlation as things have been declining. Oil continues to drop. We're down into the 60 range now. The dollar ended up being up. It's down here because it trades 24/7, but it did bounce up a little bit in Monday's session. And then we did really go back up with interest rates with the 10-year yield, and we went down with the 10-year based on price. We're still inverted with the 10 to the 3-month yield curve. The 10 to the 2-year is not inverted. We're just keeping an eye on this for right now. And this is I have a number of different ratios that I'm going to show that I was showing over the weekend as well. When we're down here, that means the market is anticipating a hard landing, where over the last couple of years, we've been up in this area where the market is considering a soft landing, meaning no recession. Now, the fears of recession are really starting to spike up, according to this chart. And we're seeing bonds really starting to outperform stocks. And we're just about ready to see a golden cross here with this ratio. And then we're going to see a lot of the same thing here. Broad market measure to short-term bonds still going down. Another broad market measure to 3 to 7 year bonds. It ticked up a little bit, but it's really been falling. The tech sector to 3 to 7 year bonds did bounce back up, but there's a lot of damage that's been done here. The Qs to 3 to 7 year bonds ticked up, but a lot of damage. And then home construction, this continues to be weak. And as interest rates are going back up, we saw some more weakness in Monday's session here. And the riskier bonds, which tend to follow more what the stock market's doing to conservative bonds, this is really continuing to drop down as well. And then are we seeing the market freaking out about inflation and interest rates? No. Even though we bounced back up here, we have been declining. Now, if they were worried about inflation and interest rates, this ratio would really be going up. Now, some of that can be explained away by this flight to safety thing. And if we see that continue, then this ratio will start to go back up. And this is short term. This is looking at cash to 3 to 7 year bonds. And we're still dropping, though, when we look at tips, which tend to outperform when the market's worried about inflation and interest rates. Now they're underperforming, and this is continuing to fall when compared to 3 to 7 year bonds. Also, still falling here, but virtually unchanged with tips to further out bonds. This is suggesting the market's not worried about inflation and interest rates. This is more deflationary. And then looking at the possible positive scenarios with our growth to value ratios, still weak here with the Qs to S&P, still above the moving average with discretionary to the S&P, but turning up, but still below a declining moving average with large cap growth to value. So the large caps under the moving average, as are the mid caps, seeing a little bit of improvement here with the small caps. All right, and then we're still going down for the most part, even though we ticked up a little bit with the S&P to utilities ratio. When the S&P is outperforming, this ratio will go up. When the S&P is underperforming, this will go down. And that's more negative when it's going down. And we came down a little bit here. We've been spiking with the staples to S&P ratio. We need that to continue to fall to be more positive. If it turns and goes back up, that will be more negative. And then we're looking extreme here with the stocks above their 50-period moving average. It's getting extreme negative here for the S&P. It's also extreme negative with the mid caps and the small caps. And when it's like this is when we look at this like an oscillator. Now, it doesn't mean we're going to bounce up out of here right away, but it does suggest that we could see some stabilization and at least an attempt at a bounce. All right, so what's the outlook then for Tuesday? We're still quite negative in the short and intermediate term. We're still mixed in the long term. We're not going to have any economic reports coming out on Tuesday. And then it's all tariffs. And even that's not really the story about what's going on. It's an attempt to change the fundamental way that the US has been doing things for the last 100 years. And of course, if you don't like Trump, you think that's terrible. If you do like Trump, you think, okay, give him some time to let this whole thing work out. Nobody's really going to know the answer to this, even though people try to confess that they do. But it's going to take some time for this to work out. Okay, and then on Wednesday, we're going to get the FOMC meeting minutes. Not sure how relevant they will be right now, but it's always worth paying attention to. And then we're going to get CPI and PPI on Thursday and Friday, as well as consumer sentiment. Again, we'll have to see how relevant these readings become in light of what's actually happening right now. Here's another look at the economic calendar. And seasonality, we're actually positive for April 8th. Is that going to matter? We're positive across the board with all the indexes. And we do see some positive seasonality with the solid line. That's taking all the years together. The dashed line is in a post-election year. And then April tends to be positive, but you sure wouldn't know that by what's happening right now. No matter how you calculate that, it's positive across the board. So we are still negative with our three smart money indicators. Even though we saw some improvements there, not enough to change them positive. We're still negative with the S&P and NYSE McClellan oscillators and summation indexes. The parabolic SAR is negative. Momentum is negative. The bullish percent indexes are negative, with the NASDAQ 100 being quite extreme negative. The Swindler trading oscillators negative, as are our moving average studies, and these are looking extreme negative as well. The ease of movement, the money flow, and the ultimate oscillator are all negative. The vortex is negative, and the long-term special K chart, which I don't show, I just tell you here, believe me, it's still negative. And then the momentum for the NASDAQ 100 is negative. Positive side, longer term, we're still holding on to uptrends with our growth to value ratios, but we're on a short term basis, we're well below the 200-day moving averages. That's negative. So you could easily put this on the negative side. I have it here on the positive side just to look for something positive, and because the trends are still positive longer term. The financial sector has been getting hit. It's still in an uptrend, and the bank ETF is still below the 200-day moving average. But on Friday and then even on Monday, we saw a little bit of a bounce there, and that could be encouraging. The mass index and the Pring bottom fisher are generating buy signals, but we have pretty much no confirmation with any of our charts other than some slight improvements that we're seeing. Okay, so our conclusion, we are negative in the short and intermediate term. Long term, we are mixed, and we still continue to be oversold. That we're seeing some slight improvements in the short term, but we're still oversold in the intermediate term, and we're still positive for right now since we're working off of that golden cross from 2023. But if we cross below it, that's really going to shift the long-term trend to negative. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.